Welcome back. You're still watching Markets at Noon, and it's a dull day for the domestic markets as we clearly see the benchmarks as well as the broader markets ranging with downtrends 25,100 trying to recover, and you see a little bit of recovery on Nifty at present. We'll keep an eye on that, but up next with us is the management of TCIEXPRESS. We have with us Mukti Lal, EDN, CFO TCIEXPRESS, to talk more on the business development plans and the quarters going ahead. Thank you so much for giving your time to ETNow. It's a pleasure talking to you this afternoon. My first question is on the guidance, and you've guided for 8 to 9% volume growth in FY26. Now, how are you seeing demand trends currently, and any pickup in September so far? Do you expect the festive season shipments to provide an incremental boost to the volumes?
Well, this is rightly said. GST cut boost up the demand in this area. So we seeing traction on to be basically on 2-3 segment, specifically one is electronics, other is lifestyle products. So hope this will be we seen in a very good growth in September month itself, and hopefully again in a second half of this year will be also getting very good, and this year we will be finished as guided 8 and 9% growth in volumes, and almost kind of 11-12% on a revenue side.
Mr. Lal, with the GST reset announcements expected to benefit the logistics sector, how do you see this playing out for TCIEXPRESS per se? Could you help us formalize more business into organized players like you, and improved growth visibility for you particularly?
Yeah, well, so this is obviously, GST V2O was waiting for the long time, and we hopeful to be bring from the 4-layer GST rates to come to 2 layers. So it has really given a reduction on GST will boost up the consumption on the across India, and we as a domestic express company, we have to be more sip the all the, whether it is auto segments, whether it's a engineering segment, whether it's our lifestyle products. So these will really help us to be ship more ships more thing. Second aspect also, with the quick commerce is also come, so we have to be fulfill these dark stores also in this festival time. So this really help us to be getting more dispatches from these all the segments, and we will be having good growth in S2 specifically.
That's right. And talking more, trucking expenses and network expansion have been weighing on margins. Given that you operate a containerized fleet, do you own vehicles directly? And if so, what the auto GST reset?
Well, so actually, this reduction of truck from 28 to 18 really not any impact on our cost part, basically, because we have the 18, we paying full GST rate of 18%, and after this GST cut also we are in the same category. So our people or our supplier, because as we know, don't own any single truck, so we completely outsourced this supply side. So these people will be also able to take the, earlier they also able to take the ITC credit on whenever they buy the new truck, or this after this GST 2.0 cut also they will be able to take the credit. So ultimately there is no benefit of that, and so other, why our cost has increased, our different aspect of that, but our cost has slightly has increased to create a network for air businesses and rail businesses, where we are in a niche segment and building up the capabilities to be de-risk our surface businesses, wherever supposing there is a slight slowdown in this one segment, so we can be do the business in another segment. So this really help will be in this year. This we already settled down. This cost has we created in a network wherever is required. So now we increasing the business on that existing network. So hopefully we will be improve our gross margin, which has been reduced in the last year almost 200 basis point. And with the obvious also this utilization level of truck is also improve with the increase in a volume. So ultimately we will be gain out of here.
Mr. Lal, in your opinion, which sectors are expected to rebound in Q2 and beyond? Do you expect weaker verticals to revive in H2 FY26, especially when GST driven demand normalization and festive tailwinds will come into play?
Yes, well, so basically, yeah, you rightly said. So, kitchenware and the, pharma and lifestyle and this engineering segment is also increased because, interestingly, like government has reduced the GST on farming sector. So that is also part of like engineering parts, whether for the naming like as a tractors industry and all. So this they have been reduced that GST, so that demand will be increased because ultimately is used for the farming. And you've seen in this year monsoon was very good, fantastic. So ultimately these sale of these items will be increased and we will be benefited out of it.
That's right. And one last thing, the margins have contracted to 10.4% in Q1, of course, due to a higher operating cost. You are targeting 15 to 16% margins by FY27. What are the key levers for margin recovery in the near term? Price hikes, operating leverage, or is it the cost rationalization according to you?
So these are the three things we are doing for that. One is once volumes will be back to like in 8 9% trajectory, so then we will be having the fill factor in our truck higher. That will be improved by almost 150 basis point. Second, whatever like we enhancing the business in a multimodal services, which vis-a-vis like this one air and rail segment, that is also like improve our margin level. And third thing, yes, we were also looking for a price hike of almost 100 to 150 basis point in this year. So ultimately, it will be put together. We targeting to be reached to back on a 13% margin level in this year, and obviously in the next year in the range of again 15 to 16%. And certainly we will be get because this multimodal services is also slightly having the higher growth and higher margin level also, because this price differentiation in between of surface and the multimodal services are like rail services 3.5x of surface, and then air is also like 3x of rail services. So ultimately these are the slightly higher margin businesses, and we will be achieve this 13% and by this year and 15 16% in FY27.
All right, Mr. Lal, thank you so much for joining at this hour with your views.